In the first quarter of 2026, Philippine banks weren't just competing to lend more or charm depositors, they were also racing to provision less for credit losses. In this race, Philippine National Bank took the lead, setting aside only 225.7 million Cuban pesos in provisions, a drop of nearly 19% from the previous year. The bank attributed this decline to improved credit portfolio performance, showcasing their confidence amid ongoing market volatility. By contrast, China Banking Corporation set aside a larger 683.8 million pesos for credit losses, up from 285.1 million pesos a year earlier. Yet with both banks reporting net incomes well above 6 billion pesos, PNB was 6.37 billion pesos, China Bank at 6.78 billion pesos, their modest provisioning helped profits weather an unpredictable financial climate marked by shaky bond prices and noisy treasury results. Despite similar profit outcomes, their paths diverged. PNB's provision was strikingly light, representing only 0.12% of its net loans. China Bank's charge, though 3 times higher in peso terms, was about 0.25% of its much larger loan book. Both ratios stood out in a nervous banking cycle, especially as peers like BPI and Metro Bank ramped provisions sharply amid external risks. PNB and China Bank, meanwhile, appeared unusually resilient. PNB's lighter provision boosted earnings and signaled better credit performance. Net interest income rose as provision expenses shrank, offsetting weaker market-related results. China Bank, on the other hand, strategically contained provisions while strengthening its buffers. With a gross non-performing loan ratio at 1.6% and coverage at 110%, China Bank's defensive stance kept net income growing despite a steeper provisioning curve. But here's the critical contrast. China Bank's loan book was cleaner, lower non-performing loans, and stronger coverage. PNB, though winning the provisioning sprint, maintained a higher NPL ratio and thinner coverage, leaving less room for error if credit quality deteriorates. China Bank's approach, though costlier in the short term, represents a more conservative, sustainable risk posture. This quarter, credit provisions were not the main obstacle for either bank. Market losses and bond revaluations, not credit costs, caused more visible bruising. Yet both banks kept profits solidly in the 6 billion peso club, offering lessons in earnings resilience and risk management. The verdict: Philippine National Bank won the sprint with the lowest credit loss provision. But China Bank's conservative provisioning and cleaner loan book may leave it better fortified for a marathon. For investors, this is a reminder: short-term gains can flatter the earnings line, but strong credit quality and risk coverage are built for endurance.